Financial planning and security can sometimes be seen as a moving target. The rules change constantly, and you need guidance to stay ahead of the market moves. This is the Lebenthal Report with Michael Hartzman and Dominick Tavella. We'll break down the news, trends, and overall direction of the markets, telling you what may be coming next, investment opportunities, and what to avoid. Now, here are your hosts, Dominick Tavella and Michael Hartzman.
All right, I'm Michael Hartzman. Today is Tuesday, September 28th, 2021, and I'm on, as always, with my partner, Dominick Tavella. How are you, Dom?
Doing great. How are you, Mike?
I'm very well, thank you. You know, every now and again, Dom, we get lucky and these shows kind of write themselves. And tonight we have a great guest, someone you and I have known for many, many, many years, and grateful he's made the time this evening. We have Mark Paris, who's the Chief Investment Officer and Head of Municipal Bonds for Invesco, which is the fifth largest municipal bond manager on the planet. And they manage $70 billion in assets Mark's responsible for. And on a day where the NASDAQ sold off, the Treasury popped, and Jerome Powell and Janet Yellen were on the Hill testifying in front of Senate, what a great night to have Mark's insight on all things municipal and all things in general.
Yeah, and the correlation here is interest rates. So we've watched and we've been warning about this for a long time, Mike, and here it is. Finally, maybe we weren't so right for a long time, and now perhaps we are, but interest rates have popped a little bit. Clearly, the expectations are that they're going higher, and generally speaking, that's not a good story for stocks or growth stocks particularly. And here we have one of the really premier experts in the bond market, muni bond market, and hopefully his insights on interest rates will help us a great deal in what we need to do with our portfolios.
Right, and for the longest time, the Fed was saying that that inflation is transitory, and that was a word that was popping around in the summertime. And we would talk to many economists and industry experts, and they were saying, "Well, I don't know how transitory it is." And all of a sudden now we're hearing that the inflation may be stickier. That's their new word, and I think that, Dom, has spooked the market as well.
So in general, we've come into this time of year anticipating that the markets would get a little bit sloppy. We didn't quite know the excuse. We could guess. And last week it was Evergrande from China real estate. Oh. This week it's we have a debt limit that the Congress needs to increase so that they continue borrowing, so that they continue spending. So there's a lot of headlines, but clearly the markets have decided maybe it's time to hit the pause button. Interest rates and inflation being a big part of this. And I think the next couple of weeks continue to be sloppy, Mike. I don't think we see a quick snapback, bounce back like we did last week. I think we might be in for a little bit of a roller coaster ride here.
We could be, but let's also put it in context. Before the show started, I looked at the recent history of the market, and the NASDAQ, the headline today was the NASDAQ had its worst day since March, and which is fine, it did, but the NASDAQ basically right now is where it was on August 19th. And the S&P is where it was on July 21st of 2021, by the way. We're not talking about years ago. We're talking about weeks ago.
Look, Mike, if we shut the year down right now and take the total return of the S&P and the NASDAQ and the Dow, we'd be happy, right? Most people would be thrilled and let's start all over again. I've been cautiously optimistic for the last couple of weeks, maybe month and a half. We've, I think now appropriately taken risk off our client portfolios, raised a little bit of cash. And, Mike, we've had a lot of people going, oh, you're being too conservative, you're being too boring. In a day like today, in the last couple of weeks, frankly, maybe we're not being too boring and too conservative. I think this does present itself as a buying opportunity. We just got to go through the little ups and downs here. And then maybe we get a little run towards the end of the year. We close the year out, hopefully on an up note.
I think that we will. And the other thing I'm really curious to pick Mark's brain about is today Elizabeth Warren, said she's against Jerome Powell being renominated. And Dom, again, you and I have talked about this throughout the beginning of the pandemic. Jerome Powell and what they did with the Fed and infusing all this cash into the market, in my opinion, last March really is what propped the market back up. And when Elizabeth Warren made that comment, I heard on TV, I had the TV on in the background, that no Democrat, leapt to his defense. So I'm not 100% sure what type of impact that'll have on the market, but I'm really curious what Mark Paris thinks about that.
Yeah, Mike, I know you've heard me say this 1,000 times, the meteor effect. Meteor comes across the sky and it's really pretty. Sometimes a meteor lands on a town somewhere and devastates it, right? So this was, like you, I'm watching, we have CNBC on, all the business channels on, and man, that was a headline. That was a meteor that came across the sky. And I honest to God, I had a pause moment that an elected official would say this publicly. Was just, whatever your opinion is of Chairman Powell, you like him, you don't. That was completely inappropriate, in my opinion. Mm-hmm. There's a better place and time to get that out there, and making that kind of headline. Look, I guess she's looking for some press. I don't know, but it to me, it was inappropriate. Even if she felt that way, it was inappropriate. I'm sorry.
No, I think what you're referring to, Dom, is I think she said he's a danger to the country.
Yeah, danger.
Yeah,
I mean, this is a chairman who, again, you like him, you don't, you think he's done a good job or not. I think he's an honorable man. I think he's tried to do the best he can. Oftentimes we describe as the person in that role as having both hands tied behind their back, because ultimately Congress and fiscal policy marries with monetary policy to come out with an outcome. So that it's only half the fight when only the Fed's there by themselves. To have an elected official out there like that, again, I can't use the word inappropriate enough.
No, and I agree.
That frightened the market, Mike. We watched a little bit of a rebound all day, and then the market leaped completely the other direction and ended the day lower. That did frighten the markets.
No, I noticed that. I mean, right after the headline, I looked up and the Dow was down 600 points at one point. So I think we call it headline risk. I mean, there was your headline. And again, I agree with you. I do think it was unnecessary. I do think it was unfair. I mean, these Fed chiefs have 6-year terms for a reason. They're supposed to overlap presidents, and they're supposed to be nonpartisan. And I think Jerome Powell is living proof of someone who has tried to be nonpartisan.
And look, just as an add-on, we have a couple of Fed governors now that are looking to resign. So there's going to be a lot of openings on the committee. Look, all of a sudden, where this was a non-issue, he was going to get elected and we'd have a very uniform policy, at least for the next 12, 18 months. Now this is a headline risk again.
Exactly. So on that note, we will be right back with Mark Paris, the Chief Investment Officer and the Head of Municipals at Invesco.
Are you paying federal taxes on your cash? I work hard for my money that I keep in cash. And for the life of me, I can't imagine why anyone would want to pay federal taxes on their cash. That's why I keep my cash in the Lebenthal Ultra Short Tax-Free Income Fund, symbol LETAX, le tax.
Rates on cash are already so low, why pay federal taxes on the interest your cash earns? Remember, it's not what you earn, it's what you keep. The Lebenthal Ultra Short Tax-Free Income Fund, LETAX, may help you earn more on the cash you've worked hard for and keep more after-tax dollars in your pocket. Find out more about the fund by speaking with a Lebenthal Global Advisors private wealth advisor or its sponsor at dcmadvisors.com.
For your hard-earned cash, why pay the tax when there's the tax?
Lebenthal Ultra Short Tax-Free Income Fund. It's not what you make, it's what you keep. Before investing, you should carefully consider the fund's investment objectives, risks, charges, and expenses. This and other information is in the prospectus, a copy of which may be obtained by calling 800-441-7031. Please read the prospectus carefully before you invest. Investing involves risk, including loss of principal. There is no guarantee that this or any investing strategy will be successful. An investor should consider the investment objectives, risks, charges, and expenses of the fund carefully before investing. The fund is distributed by Ultimus Fund Distributors, LLC, member FINRA. The fund may invest in municipal securities, the interest on which may be subject to federal alternative minimum tax. After the fund buys a security, the IRS may determine that a bond issued as tax-exempt should in fact be taxable. There is no affiliation between DCM Advisors, LLC and Ultimus Fund Distributors, LLC. DCM Advisors and Ultimus Fund Distributors are not affiliated with Lebenthal Financial Services, Inc. or Lebenthal Global Advisors, LLC.
All right, I'm Michael Hartzman, back with Dominick Tavella, and our very special guest this evening, Mark Paris from Invesco Funds. Mark, how are you?
Good to see you again, Mike. Dom, thanks for having me.
Good
I'm
evening,
thrilled to be
Mark, and
here.
welcome aboard.
Appreciate it.
It's great to see you. So let's just start right with the basics, right? Let's get a quick update on the municipal bond market as you and Invesco see it.
Yeah, I'll put today aside a bit and we can talk about it later, but I think you have to go back to the beginning of, the COVID crisis. And I think, none of us knew what a lockdown was. None of us knew what it meant to not go to airports, to not drive on toll roads. I mean, really, the only things we were using were the water and sewer authority and the power authority because we were staying in our homes. And so we didn't understand how long that would take and what it would mean. And bonds got hit really hard. Healthcare got hit really hard. Senior housing got hit very hard. But what we found as several months went on was that municipalities actually did very well. They had large rainy day funds. They were still able to collect property taxes. We were all paying it. The states that had income taxes were still able to collect income taxes. And believe it or not, there was even some sales tax collection, because I don't know about you guys, but I got a ton of packages from Amazon on my doorstep every day. And there was a rule passed a couple of years ago that said that you had to pay state taxes on purchases like that. So municipalities were very resilient. And then we had a couple of different openings. Now we're in the midst of a major reopening trade. We actually believe the economy is going to grow something in the 6.5% range this year. And that's really strong growth for fundamental municipal credits. The other thing is municipalities have taken in a lot of money from the federal government, 3 stimulus packages, and it has really changed the dynamics and the fundamentals. In the meantime, we have very, very strong demand. Now, your taxes haven't gone up yet, but there's a huge perception that your taxes are going up. So this year, we're seeing record inflows into municipal bond funds from investors who want to shield their money against taxes. And then when you look at the supply-demand aspects of the market, you're going to see a headline that says that there's a lot more supply this year. That's really not the case, because a lot of that supply is taxable. And there's a mechanism for that where you can actually refund a tax-exempt bond with a taxable bond because the Fed has kept rates so low now. And so a lot of supply in the muni market is taxable. There really isn't as much tax-exempt supply to cover what is being taken out from maturities and calls and things like that. So fundamentally, we're in a good spot. Technically, we've got good demand and actually low supply. There's some things going on in Washington that we can talk about, and we'll have to talk about whether or not refundings come back in the market or taxable bonds or what they do with infrastructure. But I still believe the retail investor has in their mind, as I do, that your personal income taxes are going to go up. And the best place to be when that happens is in the municipal bond market.
Hey, Mark, just to spend a minute on one of the items you brought up. So when we were going through COVID, we had some really concerns. I mean, a lot of these states were really dependent on, whether it was a gasoline tax or an airport tax or a bridge toll. They didn't have that revenue coming in. There was some real concerns about whether these states could pay their debt, but they survived pretty well. And then these 3 stimulus packages had big ginormous components to reimburse / help the states. They use that money really to fund their shortfalls and in a lot of cases fund their pension deficits. So they really came out of this thing pretty healthy, right?
Yeah, it is amazing to see how places like, you think about the Chicago schools, very dire credit, and now they're making their payments. We see some private pay senior living centers that got COVID stimulus money and are making their coupon payments in the bond market. Airports, airlines, that was a big deal. It took them out of the place of how do I survive, how do I tread water, to wow, now I can try and figure out how to move forward as the economy reopens. It really was a major paradigm shift. I think Bill 1 and Bill 2 were okay. Bill 3 really didn't kick the can down the street. It really punted the football pretty far down the road to give municipalities, municipal bonds, a lot of room. I'm not so sure they use too much of the money for pension plans. I think pension plan problems will always be an overhang for the muni market, but short up their budgets, short up their balance sheets, able to pay their debt, and it really has dramatically changed the fundamental landscape for municipal credit here in 2021.
Mark, one of the reasons I was anxious to have you on the show is I've been fortunate to have, one-on-one conversations with you in times when the muni market has really been turbulent. And here we are now, really on the precipice of interest rates going up, and that always causes concern in the fixed income market. But you touched on it briefly. Wouldn't it be logical that if interest rates are going to go up, especially in states like mine and yours, New York and New Jersey, that CPAs are going to start recommending again to their clients, look, your income taxes are going up, and munis are one of those safe havens. So which one is it? Are you worried about rising interest rates, or does that get offset by income taxes probably going up?
Yeah, and Mike, I always enjoy our conversations over the years, and I always have a lot of fun in those conversations and always learn a lot. So I think there's a couple of things to focus on. I think for the muni market, we are waiting for another plus, and that plus and benefit would be, believe it or not, higher income taxes. I always get knocked by my friends. You're always talking about higher income taxes. Well, that's good for the mini bond market, unfortunately. I know it's not good for everybody individually, but that's out there. It's been a perception all year long. As I said, the other key thing to note is that if interest rates are going up because the economy is fundamentally getting stronger, getting better, that is very good for municipal credits. And that means that sometimes a single A bond can become a double A bond. A triple B bond can become a single A bond. When those kind of things happen in credit improvement, the bond yield goes down and the price goes up. We call that spread compression in the municipal bond market. We've seen it many times in recoveries where people say, oh, rates are going up, but why are municipal bond prices going up? Well, municipal bond prices are going up because the credits themselves are getting fundamentally better. Collecting more taxes, having a better balance sheet, more usage for things like toll roads, you said, in the airports, and things like that. So I always am more concerned about a recession, and that's really what the big fear was this time last year, or really right before this time last year with COVID, because a recession means that everything is going down. People are taking in less revenue. Thank God this country hasn't really seen more than 2 months recession in quite some time. We bounced back. We're bouncing back now. We actually see positive growth for 2022. So if rates are going up, I'm not going to be as worried if they're going up on a normalized rate, not like a day like today, over time, and they're going up for the right reasons. And that is that the economy is getting better, and we're getting back to work and we're opening up.
And Mark, we always worry about higher interest rates and what happens to the value of those bonds. If interest rates go higher, the value goes lower. But the other side of that equation is you have bonds that are maturing, you have interest that comes credited to your account every month, every quarter, and you get that opportunity to reinvest it at a higher interest rate. So when we talk about the advantages of interest rates going up to bondholders?
Yeah, so as an active municipal bond manager, I mean, that's what we're doing in our portfolios every single day. And so if rates are going up, we can take one bond out and put another bond in at a higher interest rate. A bond can be called or matured, and we can go out and buy a higher rate. So in an active portfolio, there's a lot of levers that can be pulled that can increase the yield of the portfolio. Now, obviously, when rates move dramatically and precipitously, it becomes a bit of a problem in the short run. But if you look at the municipal bond market over the course of time, even in 2013, when we had this major taper tantrum, and the taper word is back in the marketplace now, 2014, 2015, those were great years for the municipal bond market because investors got higher rates in those years than they previously did before. So, in the short run, we all know there's going to be some mathematical pain in the price of a bond going down with rates. But the reality is, with active management, with some spread compression that I talked about, you can get past that, very well. Again, I'm always more concerned about a decrease in economic activity than an increase in economic activity that leads to higher rates, because there's a lot of things I can do in a higher rate environment.
Mark, I think many municipal bond investors who don't do this every day do not realize, unlike the stock market, the municipal bond market has a finite inventory. And I remember a couple of years ago, before the pandemic, we would hear all the time that there's not any new issuance, interest rates is too low. And that's one of the reasons I was keeping the bond market afloat was, the supply demand was off kilter. Where are we now in terms of inventory, in terms of new issuance, in terms of you who manage $70 billion being able to find investments for your clients and our clients?
So I think that, look, you can drive around the New York and New Jersey area and drive on roads and bridges and tunnels and know that those things need to be repaired. There's always the constant movement now with technology. We finance internet ability, wires being, crossed across the country throughout states, though that is infrastructure as well. And so a lot of these projects need to come to market. And we know that in Washington, they're talking about another infrastructure package. I would almost like to see it be bigger, quite frankly. And the way to finance that is in the municipal bond market. So it is a finite market. But you do get a lot of bonds taken out every year, and those bonds get refunded or repackaged and come back into the market. There are always new projects that come up, a replacement hospital for an existing older facility, a university that's adding a building. We know that the Water and Sewer Authority, the Power Authority, they're always constantly borrowing. And what I look for is diversification in the new issuance so that I can keep a diversified portfolio. I want to own a little bit of everything, and we want to do really good fundamental credit research on that so that we know where we stand. But as I said before, this is going to be a print this year of pretty close to a record year in municipal issuance. But the actual situation is there are less tax exempt bonds to buy this year, than bonds that are maturing and being called, and that is because a big portion of the market is coming as taxable. You cannot refinance a tax-exempt bond right now with another tax-exempt bond. That's from the 2018 Trump tax bill. But because absolute rates are so low, you can do it in the taxable market. Municipalities have realized that. A lot of foreign buyers, a lot of pension plans are buying those kind of taxable bonds. But in the muni market, you can stay diversified. It is a finite market. We actually grew to $4 trillion for the first time in the muni market. When I first started, I think the market was about $2.5 trillion some 25 years ago. So we have grown over the years, but once a name goes away, once it goes into a portfolio, you're probably not going to see it again. So the best time to jump on those things is when they're issued, when they're out there, do really good research, get comfortable with the name, because if you try to buy that bond in 3 months, it may not be available.
Mark, you already mentioned infrastructure, and they're talking about $1.5 trillion, all to hopefully actually get used to fix roads and bridges and ports, and not some other agenda. But in today's world, you're always hearing private-public partnerships where we have more of the corporate area coming also into this world to partner with municipalities. How does that affect the muni bond market? And is that a good thing or a bad thing?
Yeah, I really truly believe it's a good thing. You look at various bridge projects, where a private company does the bulk of the building of the project, but the private-public partnership is that we can go out and issue a tax-exempt bond to finance that. That's a really good way to get things done if you believe that the private entity is probably going to be a lot more.
That's normally a revenue sharing arrangement, yes. Right, Mark?
Yes, it's usually a revenue sharing arrangement over some contract over some period of time. But remember that a lot of these toll projects bring in a tremendous amount of revenue, always usually have a surplus for the year to cover the debt service, to cover the operations, and then there's usually a pretty good surplus left over as well. So we welcome that if that comes in the infrastructure package. We think that some sort of agreement would be there. I thought it'd be done by now. I'm a little surprised that they're still kind of beating each other up over that end of the market. But I always like projects that are for transportation, for delivery of services, power, water, tangible projects, essential services that we need every day. And as I said, you look at the roads and the bridges and the tunnels, at least in our area, and I'm sure in other parts of the country, they certainly need to be updated and fixed. And a great way to do that is with a public-private bond. A little bit of revenue sharing goes in there. The bond comes tax exempt, so they get a lower interest rate on the project. Everything hopefully gets done nice and neatly, and people use it.
So on that note, if politics gets in the way and this bill gets delayed or doesn't happen, what's the effect on the municipal bond market, Mark?
Yeah, so when I look at infrastructure at $1 billion or $1.5 billion, I would say that would probably come to the tune of about 80 to $100 billion a year in issuance. That's not a lot of bonds in the scheme of things. Some of it might even come taxable. I don't think it changes the supply demand aspect of the market that much. The other thing is that, it's great that the government is talking about infrastructure, and I certainly do want the government to help out. The reality is the municipal bond market has been going on for a long time without the federal government being that involved, and infrastructure projects do get done. They do get negotiated. The best way to do it is to borrow the money in the tax-exempt market at a much lower rate. So, we talked about this in 2016 and nothing happened. For the 4 years of Donald Trump. Now we're almost a year into the Biden presidency. Again, nothing's happened. The municipal market has done just fine without it. I believe there's been a lot of infrastructure projects that have come. This would certainly jumpstart it and add to it, but I don't think it would change the supply-demand dynamics of the market. I think it would come at a very sort of even pace. And then again, they'd be projects that investors want to own: toll roads, bridges, tunnels, infrastructure for the internet and things like that. So it would be another good thing for the muni market, in my opinion. But I don't think that clearly it's been delayed so long. It's not an absolute necessity.
Yeah, I remember during the Trump administration, it was infrastructure week every week, and something would always step on them getting anything done. Mark, you said you could stick around for the next segment.
Absolutely.
So
yeah, I'd love to pick this up just on the other side of the commercial break.
So we are bumping up against a break. So we'll take a quick break and we'll be right back with Mark Paris.
Financial planning and security can sometimes be seen as a moving target. The rules change constantly, and you need guidance to stay ahead of the market moves. This is the Lebenthal Report with Michael Hartzman and Dominick Tavella. We'll break down the news, trends, and overall direction of the markets. Now, back to the Lebenthal Report.
All right, I'm Michael Hartzman, back with Dominick Tavella and Mark Paris from Invesco. Mark, on the open, I know you were listening in. We were talking about Jerome Powell and him testifying today up on the Hill, and then to me and Dom, I think we agree, the rude comment that Elizabeth Warren made, calling him a danger. To me, what Jerome Powell did last year when the pandemic started and really flooding the market with cash and propping up the market, I mean, to me, he was one of the few adults in the room last year when this thing really locked us down. So I just wanted your opinion on, if you don't mind, on the job Jerome Powell has done and whether you think he deserves to be renominated by the Biden administration.
Yeah, so I definitely agreed with a lot of yourself and Dom's comments from earlier. I was stunned by the senator's comments. I do believe Jerome Powell's done a great job. You get in these situations where Fed chairmen never see things, or they see things for the first time. And, Ben Bernanke in 2008. This was a unique situation, and I thought he handled it really well. He's got a lot of challenges right now. I mean, these couple of Fed governors that have resigned over investing, and he said it today. He said, look, maybe the rules need to be changed, because he doesn't necessarily think that they were outside of the rules. He just thinks the rules were lax. That's not his fault, in my opinion, anyway. And then, you've got Senator Warren saying it. And as you said earlier, Mike, nobody on the Democratic side stood up for him whatsoever. And that was a little bit stunning to maybe tonight or tomorrow we'll hear something. I don't think so, though. And then you've got the fact that he has been much more hawkish. You talked about the fact a couple of months ago that, in developing nations, it's hard to keep inflation up at 2%. And that's why he kind of thought it was transitory. Now, as Dom mentioned earlier, they're talking about it maybe being not so transitory or a little bit longer. And so it almost feels like he's changing his tune a little bit to adapt to some of the struggles that are going on. I personally would say that I like Jerome Powell, and I'd like the stability of keeping the same Fed chairman there. I think it will roil the markets. Dominick, you said earlier, we're probably going to be here for a few weeks. And I think, this stuff is going to cause us to be here for a few weeks. The chance to bounce back from a day like this where the bond market sells off, the equity market sells off, when you have this kind of external noise and you're going to change a Fed chairman. And then, look, behind the scenes, what is Janet Yellen's real role? Is she going to have a lot more say in who becomes the Fed chairman if it's not Jerome Powell? I think we're going to be in a more dovish tone, though. I think that's what the administration wants. I think they do feel that Jerome Powell did a great job of putting a lot of money into the system. It's politics, guys, and people can get burned even when they don't put their hand too close to the fire. It was a little disappointing to see from my seat.
And Mark, for somebody like us that we're trying to manage client assets and manage risk, talk about shooting yourself in the foot. We're dealing with this crisis in China with this massive real estate company that might go bankrupt. We're dealing with a debt ceiling where Congress can't make up their mind. We're dealing with 3.5. I mean, all these issues are on the table already. Do we really need this distraction? I think the stability, whether you're a big fan or not, the stability of having a Fed in place that we know and understand, I don't know why we need to go shoot ourselves in the foot. And politics is the definition of shooting yourself in the foot.
Yeah, look, I think that's another issue that we're going to have to deal with. But the debt ceiling usually works itself out. We've seen this movie before. We saw it from the Democratic side. We've seen it from the Republican side. So I'm going to say that the odds are that kind of gets worked out. I do believe that the markets will rebound from this. I do believe that, at the end of this year, we're going to be at a point where rates probably aren't that much higher than they are now. The thing about COVID is maybe the equity markets are past COVID and stocks are up a lot, but I don't think the bond market's done with COVID. And I think, you get excited because you see a reopening going on. You see airline traffic up, and then you hear something, and over the summer it was the Delta variant. And I'm not saying anything like that is coming back, but I think I'm not getting back to my office probably till November. I think a lot of people are probably going to get back in January and February, and that's going to mean that we're going to be around the 6% growth till the end of the year. 2.5, maybe 3% next year in growth, nothing really over the top. And I think that what we're seeing is the volatility of what's going on globally, China, as you mentioned, what's going on with the economy, and then what's going on in Washington. And there's going to be a lot more noise out of Washington, going into the midterm elections, certainly next year. We don't need it, we got it, but I think some of the things will work out on their own.
Speaking of noise, let's get a little nostalgic and let's talk about Meredith Whitney for 2 seconds.
Oh no, Mike.
I remember being in a room with you, and this may not be an exact quote, but I think you said Meredith Whitney was the greatest gift to the municipal bond market ever. Right? Because she basically said on 60 Minutes, the muni market was dead. It was dead. States were going to go out of business. And again, we love talking to you because the context and the common sense that you bring to all this. So you mentioned a couple of things that you worry that we're not done with COVID yet, that we have this noise. But is there anything really at this moment, Mark, that keeps you up at night and says, well, if this happens, then the muni market does see some real volatility?
Yeah, so look, I never like surprises. And, I was watching a football game that Sunday night. I'll never forget it. I turn on 60 Minutes and there's an equity analyst talking about how bad my muni market is. Drove me to tears that night. And that's a nice, polite way to say it. But that rundown in price was this amazing opportunity to buy bonds at, ridiculous prices because too many investors followed that advice. So, the retail investor is worried about interest rates. The retail investor is worried about what's going on in Washington, what's going on globally. The one thing that we have in our favor right now is that cash rates are very low. So going to cash, yes, it's safe, but you're not getting any benefit out of it. But when everybody does run to cash, that creates a problem in every market, and especially in the municipal bond market because, there's only one kind of door to go through. It's a finite market. Everybody's trying to sell the same bonds. However, those periods of time have proven out to be some of the greatest opportunities in the muni market. 2009, 2010, after the '08 crisis, 2014 and 15 after the taper tantrum, 2017 after what we call the Trump dump, because everybody thought when Donald Trump was president, he takes tax rates down to 25%. And with the SALT cap, most people actually in the higher income brackets got their taxes up. And this has been a very good comeback for municipal bonds as well. So, I'm worried that investors get spooked here and there with all the noise that is going on. And then you get this flush of withdrawals. The one thing I will say that's very different now, specifically in the municipal bond market, to some of the other times when we were, hearing that there could be a sell. There's a lot of cash in the system, not just investors having cash, but mutual funds holding on to cash. We have higher cash balances in our mutual funds right now because the set of investments were kind of waiting and trying to be really good bond pickers. And if I look at the competition out there, not just our funds, but other funds, there's a lot of good cash in the system, and that should dampen things out. But to answer your question, look, we manage $70 billion. This kid from Brooklyn never thought I'd have that opportunity to do that. So everything keeps me up at night because I want to be a good steward for our shareholders across all of our mutual funds.
And Mark, you brought up a very key point. I apologize for repeating it, but it really is all about the states and the cities being able to pay their debt. And financially, they really are very healthy, right? Fiscally, they've maybe caught a little religion. They got a lot of help from the federal government. Economic activity is improving every day. So these states are in a pretty healthy spot, and the ability to pay their interest and the debt is pretty good, right? This is a pretty good sector to put some boring, safe money.
Fundamentally, we're in great shape. And, I think that the stimulus money changed the ballgame. I think if you thought, in the summer, they're going to need more money, they got a little bit of it before the election, and then they got a lot of it. And it really did change the dynamics in the muni market significantly. Minnesota went from a deficit to a surplus overnight. And there was a lot of that in the municipal bond market, whether it be a school district, a hospital that suffered through COVID. And again, this is not necessarily a short-term patch. If they manage it right, I hope they got some religion, Dom. We don't know where all the money's going at all the time, but that's a job of our analysts.
And correct me if I'm wrong, I don't want to put you on the spot, but I think New Jersey ended up the year with a surplus in their budget. I don't know the last time Jersey had a surplus in their budget. Do you?
A long time ago. So, you get that influx of money, and it definitely changes the ballgame. Fundamentally, if you do really good credit research with the money that's come in, I think we're in as good a spot as we've been in a long time in the muni market, fundamentally because of the stimulus money.
Mark, can we talk about sectors for a second? I know we talk about infrastructure a lot. Are there other sectors that either you're a little bearish on, whether it's hospitals or assisted living facilities or universities, or that you're bullish on at this point?
Yeah, so I'll start off with a bear, and that is, yes, students are back. I have 2 children in college and 1 in grad school, but student housing is still a bit of a tricky spot in the municipal bond market. There are a lot of student housing projects that aren't really affiliated with the universities. We've seen some of this happen in the Midwest over the years where you didn't quite get 100 cents on the dollar. And so I would be very careful in the student housing sector. I think they're thinking of different ways to, handling through COVID, and, are there going to be more online classes at certain types of universities? Whereas, the bigger universities will probably just be fine. So that's something that we're watching very closely, but on a security by security basis. And that's really where it comes in for us. It is not necessarily the macro of what sectors we like and don't like, but the micro of the individual sector. For instance, there's a lot of noise on hospitals, right? I mean, they've gone through COVID. They had to spend a lot of money on PPE. They had to put security in the hospital. Yet, if you take a look at an individual hospital and you look at the demographics, the geographics, the competition, you see how they've come through COVID, and you see what they were pre-COVID. And what I mean by that is if you can find a hospital that did a lot of elective surgeries pre-COVID and is now getting back to that, that's a very profitable thing. A hospital that was in the baby delivery business, they do very well. And so, those are the kind of things that we like. I consider this market for municipals right now to be a bond pickers market. And we don't say that a lot in fixed income. That's reserved for the stock pickers. But this is really a bond pickers market of knowing what kind of credit you're buying, doing really good research on that credit, and finding out where they were pre-COVID and what you think they are post-COVID. And then, getting the right interest rate for the risk that you're taking. But I think the reopening trade in general, we still love airports. Toll roads are really something that we're following very, very heavily. And I think that, there's plenty of stuff out there in the muni market that, is going to continue to do really well as this economy gets back to activity normalization. And then we'll probably next year get back to some sort of growth normalization, which again will probably be around 2.5–3% next year, we think.
Hey, Mark, I'm going to piggyback on Mike's question. We get to put the portfolios together. Myself and Mike make decisions every day. And one of the areas that's really worked out well for us is the high yield space in munis, not very well known out there. And we've done fortunate because the economy has recovered. Any worries and other things that you would avoid?
Yeah, so look, I think high yield municipals are definitely a part of people's portfolio. It's a great place to get more yield, to get really good total return when the economy's growing. So, I was out there this time last year saying, hey, don't forget about the high yield part of the market, because if this economy is going to reopen, high yield will probably do better than investment grade, and it has.
It has. We listened to you on that one, Mark. Thank
you. My pleasure. And so, you look at the high grade muni market, single A's, double A's, they're very low interest rates because interest rates are low in general. But in high yield, we have that spread component. And as the economy does better, those credits should do better. That spread should come in and the price should go up. I truly believe high yield is a great thing to have as part of your overall municipal portfolio, depending on where you be. And that comes to the fact that you're going to need a manager that does a tremendous amount of credit work. We go out and do a site visit. We send our analysts to that project to make sure that we met with management, that we understand what's going on locally, politically in the area. Now, it's been hard, but I will tell you, we did a ton of Zoom meetings. And it's funny because I don't see that done enough by the industry. We stayed to our standard and said we still wanted to meet with management. We forced them to do a meeting like this, get a sense of who they were, what they wanted to do, what their challenges were. We think that adds a lot of value to the investment. And then you add a really good relative value component of what do I need to be paid, for that bond. So high yield is a great thing to have in your portfolio. It definitely does get hurt. I mean, you look at where high yield funds were March, April, May of last year. It all depends on the duration of a possible recession. Thank God this was a deep one, but it was only 2 months, and we don't see another one coming soon. So we still believe high yield should be an important part of your portfolio.
Mark, believe it or not, we are just about out of time. And again, we know you're a busy guy, and we just cannot thank you enough for making the time for us this evening.
And it was great to talk to Dom and Mike. Fantastic.
Mark, and I want to remind our own clients and viewers that our ability to speak to people like you who give us these insights and little tidbits, little jewels, will really allow us to make good decisions on our portfolio. So thank you. I really appreciate it.
And I guess, Mark, my last point is we had Dr. Siegel and Jim Rogers back to back, and I called them Babe Ruth and Lou Gehrig. So you're right in that lineup, my friend. It's like having Yogi Berra on tonight.
I love it. I love it. Okay, I can be Yogi. Thank you so
Joe
much.
DiMaggio.
I was say, and Mike, if he thinks that's a compliment, we should have asked him first.
Everyone loves Joe DiMaggio. Mark, thank you again.
Mark, I couldn't appreciate it more. Thank you.
Great to be here, folks.
We will be right back. Thank you, Mark. When you're thinking about where to park your cash, For over 30 years in the business, I've been a fan of funds like the Lebenthal Ultra Short Tax-Free Income Fund. It's managed for cash and designed so the interest income you receive is free from federal taxes. And who doesn't love paying less taxes?
Mike, generating interest that's free from federal taxes is appealing, but I've been in this business for a long time, and people love the potential for more income on their hard-earned cash.
Sorry, Dom, but the beauty of the funds is paying less taxes on cash.
No, my friend, it's the potential for more income.
Less taxes.
More income.
Less taxes.
More income.
Less
For
taxes.
your cash,
More income.
ask your advisor
Less
about the Lebenthal
taxes.
More
Ultra
income.
Short Tax-Free Income
Telling you,
Fund,
less taxes.
or find out more at dcmadvisors.com.
Well, Dom, one thing I know we agree on, it's not what you earn.
It's what you keep.
Lebenthal Ultra Short Tax-Free Income Fund. Symbol LETAX. LETAX. Before investing, you should carefully consider the fund's investment objectives, risks, charges, and expenses. This and other information is in the prospectus, a copy of which may be obtained by calling 800-441-7031. Please read the prospectus carefully before you invest. Investing involves risk, including loss of principal. There is no guarantee that this or any investing strategy will be successful. An investor should consider the investment objectives, risks, charges, and expenses of the fund carefully before investing. The fund is distributed by Ultimate Fund Distributors, LLC, member FINRA. The fund may invest in municipal securities, the interest on which may be subject to federal alternative minimum tax. After the fund buys a security, the IRS may determine that a bond issued as tax-exempt should in fact be taxable. There is no affiliation between DCM Advisors, LLC and Ultimate Fund Distributors, LLC. DCM Advisors and Ultimate Fund Distributors are not affiliated with Lebenthal Financial Services, Inc. or Lebenthal Global Advisors, LLC.
Michael Hartzman back with Dom, and wow, that was for such a dry topic, I haven't had that much fun talking about investments in a very, very long time. Mark was just terrific.
Well, Mike, and I'm sure you hear it as well as I do. People are like, well, that's a kind of a boring subject, right? And you don't realize, the average person doesn't realize this is a very complex area. And when you talk about, there are many municipalities, as there maybe more than there are stocks out there, and each one of them is different, a different flavor and different outlook, and they all have to be analyzed and gone through and cherry picked, and it's a lot of work.
It's a lot of work, and Mark said it very quickly. And again, we're not exaggerating. You and I literally have known Mark for 20 years individually, and he's a guy from Brooklyn, right? I mean, he's a guy who brought his way up through the system, and he literally, how much has he managed, Dominic?
$70 billion.
$70 billion, and and we've had him at our events, and he's able to explain to clients a very complicated subject in plain English. Is why we were so happy to have him this evening.
And look, Mike, maybe I'm not sure whether it's the chicken or the egg, whichever comes first, but you and I seem to gravitate to these very common sense, earthy people that do a really good job and have that really fiduciary feeling that, hey, I'm responsible for people's money. I got to do the right thing. So he's top of our list. And again, gratitude to him and the firm for allowing him to come on board with us and spend this time.
Absolutely. Very, very grateful to the folks at Invesco for getting us Mark. And you know what? I just want to, before we got to go, I just want to talk briefly about the high yield market, because we threw that term around a lot towards the end of the segment. And why don't we just talk a little bit about what we meant by high yield and why they're so valuable and why we put them in the portfolio, Dom?
Sure. So generally speaking, high yield bonds, they could be corporate, municipal. These are lower quality, lower rated bonds. So the higher the quality, theoretically, the safer they are. The lower the quality, there's always that risk that maybe the corporation or a municipality can't pay their debt. So you're taking on more risk. You're also getting paid for that risk. They're willing to pay you a higher interest rate. The problem is if you're going through a recession, those can become very dangerous things to own. But in an economy that's growing and very healthy, very strong, you can typically buy these bonds at a discount and then get an exceptional rate of return. Conversations with Mark and people like him out there tell us, hey, the economy is on a good, sound footing. It's healthy. It's growing. You can take on that additional risk and then obviously take on that additional profit. And that's exactly what's happened.
And the beauty or the importance of having a partner like Invesco in this sector is Invesco is the second is the number 2 high yield manager in the entire country. So if Mark or someone on his team calls up a city manager or someone to talk about their issue, they're gonna get someone on the phone and they're gonna get the information they need. So they're not, making these recommendations based on a third party credit agency. They have boots on the ground and they're doing their own research and getting the answers that they need.
And Mike, I always give them credit for being chirping in our ear, right? And we talked about Meredith Whitney scenario, but we didn't mention Puerto Rico. And
Right.
literally, I remember being, I think it was with you at dinner with a municipal bond manager, and just almost casually, do you own any Puerto Rico bonds? And I don't remember if we did or we didn't. All I know is the next morning we went in there and we cleaned house. We sold every single Puerto Rico bond we owned. We got out of every single mutual fund and ETF that owned Puerto Rico. And boy, that did not look smart for about 3 to 6 months. And then Puerto Rico collapsed, and you had bond owners out there that walked away with 30 cents on the dollar. So speaking to these people is really critical to our investment decisions.
Yeah, and I remember another time, it was back, I think he mentioned 2017, one of those bond little mini explosions. And I got him on the phone. A phone call was arranged, and I said, Mark, our clients are freaking out, and the bond market's really taking it on the chin. One of those few times it's really under a lot of pressure. And very calmly he said, give it 2 weeks, give it till Thanksgiving, and things will calm down. And within a few days he was 100% correct, and that gives us the confidence to say that to our clients. Let's just not over.
And Mike, I'll take it one step further. Maybe we end up being buyers in that environment instead of sellers, right? Because we have people that we trust that we can consult with.
Exactly. So I really appreciate Mark being on the line with us tonight. And again, his colleagues, Eric and Charles, who helped us get Mark on the call. I hope our viewers enjoyed it. And Dom, we always say it, but the time went flying by, and we are just about out of time.
Well, you have a great evening, Mike, and look forward to next week's. I'm sure the ride's going to be a little interesting these next 7 days.
Stay safe, everybody, and we'll see you down the road. Have a good night, everyone.
Good night, all.
Thanks for tuning in to the Lebenthal Report.